Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, January 17th, 2025. Wall Street is clearly confused about which way the economy will turn next. After surging above 6,000 to hit an all-time high a few days after the November election, the S&P 500 index has wavered above and below that benchmark ever since. So here's the chart of the S&P 500. Now this is the past 6 months. You can see here the big dip in August when for a little while there, Wall Street was afraid that we had a recession in the works. Then we got a much stronger than expected GDP, gross domestic product report, for the second quarter that really changed Wall Street's thinking about not just which way the economy was going to go, but how that might shape monetary policy for the next couple of years. So suddenly you see the stock market surging, again, another pullback, but by and large, and then, of course, here's right before the November general election, and then a big rally there. But really, you can see here, since it peaked first week of December, it has not been back to that level since. Now, that's a new all-time high, okay? So, I mean, it's not always just going to set a new record every day. But nevertheless, we had one big drawdown here, and then a recovery, and so on. But, you know, right now, stock market-based, Wall Street's kind of in a wait-and-see kind of period. Now, at the same time, the yield on the 10-year Treasury note, and I'll pull that up for you here, rose above 4.8% this week for the first time since the stock market began its massive rally 16 months ago. And here's the past 6 months of the yield on the 10-year Treasury note. Now, over here, remember, these are the closing yields, so you don't see 4.8 here. But in the intraday trading earlier this week, it did hit 4.8 several times. Right now, you can see today it's at about 4.6. But here's the past 6 months. And again, rates are rising the same time the stock market's rising. Why? Because rising rates means, at least the bond market believes that a recession is not imminent. And if a recession is not imminent, then that's good news for the stock market. So it's not unusual for them both to respond favorably to the strong economic data, really during the second half of all of last year. So in short, the stock market doesn't know what to expect, while the bond market is assuming a strong economy. Because, you know, you look at the stock market time, you know, not sure, you know, what's going to be happening here in the months to come. Bond market's not waiting around. It believes that the economy's stronger than people thought it would have been by this time. You know, particularly last summer, if you asked people to project 6 months out, do you think we'd be looking at 2 straight months of GDP over 3%? Most people probably would have said no, but that's where we are. So we may get a better idea of what the incoming Trump administration has in store for us during the president's inaugural address this Monday. It'll probably be light on details, but we should get a sense of what his highest legislative priorities will be in the near term. But regardless of what is or isn't said on Monday, it may take a few weeks for that legislation to take shape. Presumably, it will include border security, tax relief, and import tariffs. After that, the internal politics of Washington, D.C. will dictate what happens next. In the meantime, there is money to be made by correctly guessing which of Trump's policy items will happen as envisioned and which will end up falling by the wayside. More often than not, the wayside wins in Washington, D.C., which means a lot of stocks will be making big moves one way or the other once that becomes apparent. That's because our economy is remarkably resilient. It shook off the coronavirus pandemic while the rest of the world struggled to survive, and is growing at a healthy rate without the need for monetary or fiscal stimuli such as trade tariffs, tax cuts, or artificially low interest rates. Now, that's also why the bond yield's higher, because they know that Trump prefers lower interest rates. He said that. He's a real estate developer. Developers live on borrowed money, so from their perspective, low interest rates are good. But the bond market essentially is saying, regardless of how anyone feels about where they would like interest rates, in the end, the economic data is going to dictate exactly where that goes. And right now, quite frankly, jobs market's strong, inflation it just, the bond market essentially is saying, we don't believe that the Fed will be cutting interest rates much more. Now, Trump has several bargaining chips at his disposal. Since our economy does not currently require any of that artificial stimuli to keep growing, he can trade any one or all of those things off for other items that require political compromise, such as changes to Social Security and other programs that he would like to enact. Now, I don't think that'll happen either. There are very few elected officials who are willing to endorse reducing benefits for seniors and other members of their constituency that rely on those programs to get by. In the end, we may only see moderate changes along the margins of some of those programs. In other words, this may all end up being a massive tangle of political gridlock, which would be fine with me. The economy is growing at a sustainable pace of roughly 3%. As I mentioned earlier, unemployment's low, around 4%, and inflation is holding steady near 3%. Those are solid numbers that are indicative of an economic system that is working. That is why all the major stock market indexes hit all-time high recently, and why our nation's leaders should proceed cautiously before making any major changes. That's this week's update, and I look forward to talking to you in another week.